What is a hammer clause? A hammer clause is an insurance policy provision which stipulates what happens when an insured does not consent to settle a claim as recommended by their insurer. So let's back up here and explain what we mean. An insured is sued for an error they made that's covered by their insurance. After careful analysis of the allegations and a settlement offer from the plaintiff, the insurance company recommends that the insured accepts the offer and settles. The insured disagrees with the recommendation, so now what happens? This is where the hammer clause comes into place. A hammer clause stipulates what happens when the insured does not consent to settle based on the insurer's recommendation. Depending on the wording, if the insured doesn't agree to a settlement, they might be responsible for any defense and settlement costs going forward. The hammer clause appears in policies such as directors and officers liability, employment practices liability, professional liability, and errors and omissions. It's often found under the heading consent to settle. Hammer clauses can vary greatly. Let's go through an example to see how they work. ABC Limited hired Johnny to work at their company. A year into his tenure, Johnny committed a crime at work, and ABC terminated his employment. 1 month later, ABC Limited received notice of a lawsuit filed against them by Johnny alleging wrongful termination. Johnny feels he's been the victim of retaliation. ABC notifies their insurance company of this claim, and under the EPLI policy, the insurer starts funding the defense. As additional facts present themselves, the insurance company determines that the cost of continued litigation may well exceed the cost of the settlement offer presented by the plaintiff. ABC Limited rejects the settlement. They argue the reason for terminating Johnny was based on the crime he committed. ABC Limited fears that by settling, they're admitting to wrongdoing and their reputation would suffer. The hammer clause provision in ABC Limited's EPLI policy stipulates how ABC will contribute to funding the defense if they choose to continue to defend, rather than accepting the settlement the insurer recommended they take. That may mean that they would have to shoulder all additional expenses going forward, both defense and settlement. If their policy has what's called a softened hammer clause, ABC Limited could either accept the settlement as recommended by their insurer or move forward with defending the lawsuit knowing they might have to absorb a portion of the costs. In this situation, the hammer clause will set out in advance the percentage of defense costs each party is responsible for after the insurer recommends settling. For example, if the hammer clause stipulates 70-30, then the insurer will be responsible for paying 70% of the defense costs, while the insured would pay 30%. Again, this is only the case if the insured chooses to continue defending despite the insurer recommending that they settle. If you enjoyed the video, like it, share it, and tell people about it.